Welcome back to The Entrepreneur's Guide to Financial Statements. Today, we'll be breaking down one of the most essential financial documents you'll ever use, the balance sheet. This statement is a snapshot of your business's financial condition at a specific point in time and is critical for evaluating your company's financial health. Let's take a closer look. The balance sheet revolves around a simple but powerful equation. Assets equals liabilities plus equity. These three components give you a clear view of what your business owns, what it owes, and what is left over for the owners. Let's break down each part. First up, assets. Assets are the resources owned by your business that have economic value. They are divided into two categories, current assets and non-current assets. Current assets are those that can be converted into cash within 1 year. These include cash itself, accounts receivable, and inventory. Current assets help keep your business running smoothly by covering short-term expenses like payroll, supplies, and utilities. On the other hand, non-current assets are long-term investments that won't be converted into cash within a year. These include property, equipment, and long-term investments. These assets play a critical role in the long-term growth of your business. Now, let's move on to liabilities. Liabilities represent the debts or obligations your business owes to others. Like assets, they're categorized into current liabilities and long-term liabilities. Current liabilities are short-term debts that must be paid off within a year. Examples include accounts payable, short-term loans, and accrued expenses. Managing your current liabilities effectively is crucial for maintaining day-to-day liquidity. Long-term liabilities, on the other hand, are debts that extend beyond 1 year. These include long-term loans, bonds payable, and mortgages. While these allow you to finance significant investments like property or equipment, they also increase your financial obligations over time. Finally, we have equity, also known as shareholders' equity. This represents the owner's stake in the business after all liabilities have been paid off. It includes the initial capital invested as well as retained earnings, which are profits reinvested into the business rather than paid out to shareholders. Equity grows when your business is profitable, but if your liabilities start to outweigh your assets, equity can shrink. This is why monitoring equity is vital for understanding the long-term sustainability of your business. Now that we understand the components, let's discuss how to analyze a balance sheet to assess your business's financial health. Two key metrics we'll focus on are the current ratio and the debt-to-equity ratio. First, the current ratio is a simple measure of liquidity. It's calculated by dividing your current assets by your current liabilities. This ratio tells you how well your business can cover its short-term obligations with assets that can be quickly converted to cash. If the ratio is above 1, it means your business has more than enough current assets to cover its current liabilities. But if it's below 1, you may have trouble meeting short-term debts, which could signal liquidity issues. The second key metric is the debt-to-equity ratio, which measures financial leverage. This ratio is calculated by dividing your total liabilities by equity. It helps you evaluate how much of your business is financed through debt versus what the owners have invested. A high debt-to-equity ratio means your business is relying heavily on debt, which could lead to higher financial risk. While borrowing can fuel growth, too much debt can become overwhelming, especially if business conditions change. In this scenario, high debt levels mean larger interest payments, which can erode profits and reduce your cash flow. If cash becomes tight, you may struggle to meet your obligations, putting your business at risk of defaulting on loans. In this scenario, high debt levels mean larger interest payments, which can erode profits and reduce your cash flow. If cash becomes tight, you may struggle to meet your obligations, putting your business at risk of defaulting on loans. Understanding the balance sheet and how to analyze key ratios can help you make informed decisions about your business's financial future. By monitoring your assets, liabilities, and equity, and keeping an eye on your current and debt-to-equity ratios, you'll be better prepared to manage your business's growth and avoid financial risks. In our next video, we'll explore the cash flow statement to help you ensure that profits translate into cash flow. Thanks for watching.